You have the entrepreneur mindset to run a profitable small business. So why does it still feel off? You built the product, you priced it right, you showed up every single day, and on paper, everything looks fine. But deep down, something doesn't add up. Not failing, not struggling, just not working the way it should. The numbers say you're okay, but your reality says otherwise. That feeling, it's not a doubt, it's a signal. After 19 years in corporate finance, analyzing thousands of small businesses, I've seen what actually separates the ones that quietly build wealth from the ones that generate revenue and stay stuck. And it's not better products. It's not smarter marketing. It's not even the market itself. It's small business psychology. Most people don't have a strategy problem. They have an entrepreneur mindset problem. This isn't just business advice. These are the patterns behind real, profitable businesses. 15 signs your business looks successful, but isn't actually building wealth. In theory, a profitable business makes more money than it spends. While reality, most small business owners who are already profitable don't know it. Here's why that gap exists. The version of business success you absorbed from every podcast, every LinkedIn post, every business book is built around one metric: revenue. Revenue is visible. Revenue is what you announce at networking events. Revenue is the number people ask about at dinner. Profit is invisible. Profit doesn't announce itself. It doesn't drive a $54,200 pre-owned Mercedes to a co-working space. It sits in a reserve account, compounding quietly while everyone else is performing success. In a 2019 analysis of 27,000 small business financial statements, 58% of owners who self-reported financial stress was technically profitable by standard accounting measures: positive net income, positive cash flow. Technically, fine. They just couldn't see it because they were measuring revenue when they should have been measuring margin. The most dangerous position in small business is not bankruptcy. It's the gap between being profitable and recognizing you're profitable. That gap costs, on average, $47,000 annually in unnecessary overhead, in avoidable decisions, in psychological pressure that drives bad capital choices. Today, we close that gap, not with motivation, with the exact psychological fingerprint I spent 19 years watching profitable operators run on pure instinct. Garrett is not a name you'll recognize. He runs a commercial cleaning company out of Atlanta, 6 employees, no investor money, no business degree, no LinkedIn presence. When I reviewed his financials in 2021, Garrett had $184,000 in annual revenue and $67,400 in net profit, a 36.6% profit margin. The industry average for commercial cleaning is 11%. He was operating at more than triple the industry margin, without knowing it. When I asked Garrett if his business was profitable, he said, "Honestly, I don't know. I feel like I'm always scrambling." He was not scrambling. He was 3 years ahead of where most operators in his category would ever get. But the way Garrett ran his business, the instincts he operated on, were so quiet, so unglamorous, that they didn't register as success. They just felt like how he did things. Garrett paid himself $4,200 per month, deliberately below what his margins allowed. The rest sat in a reserve account. He had 8.3 months of operating expenses in cash. He drove a 2017 Ford F-150, paid off, 311,000 miles. When a commercial real estate agent pitched him a $3,800 per month office lease to look more professional, Garrett said no in 14 seconds. No spreadsheet, no advisor. His gut made the calculation before his brain caught up. That gut had a name. Garrett just didn't know it yet. Here is what the corporate framework actually says about this. In corporate acquisition analysis, the process large companies use when evaluating whether to buy a smaller business, analysts look for a specific cluster of behavioral indicators before they ever look at revenue. Not instead of revenue, before it. This cluster has a name. It's called the Lean Operator Profile. The lean operator profile is not a certification. It's not a management philosophy. It's a behavioral fingerprint that emerges in founders and operators who have, consciously or not, aligned their instincts with how capital actually compounds, rather than how success is traditionally performed. Fortune 500 acquisition teams use it to filter targets. If a business owner demonstrates 8 or more of the 15 behavioral indicators, that business is statistically more likely to survive economic contraction, maintain margins under pressure, and compound value without requiring external capital injection. Most small business owners never encounter this framework because it doesn't live in entrepreneurship books. It doesn't get taught in MBA programs. It lives in the internal due diligence playbooks of corporate M&A teams, the ones reviewing thousands of small businesses before writing a check. Garrett hit 13 out of 15. He still didn't know his business was profitable. Here are all 15. Track your own score as we go. Sign 1. You barely think about daily operations. Not because you're disengaged, because you've systematized your business to the point where the basics are invisible. You don't make micro decisions all day because your SOPs handle the friction before it reaches you. Garrett had 11 documented operating procedures for a 6-person company. Most operators in his category have 0. In corporate, we call this operational abstraction. It's a precondition for scale. If you're in the weeds every day, you can't see the map. Sign 2. You feel physical discomfort around unnecessary overhead, not strategic concern. Physical discomfort. The idea of a $4,800 per month commercial lease makes your stomach tighten before your spreadsheet opens. A $1,200 monthly software stack that serves 3 people doesn't feel like a cost. It feels like a leak. That response is not anxiety. It's your risk assessment system functioning correctly. Garrett turned down the $3,800 lease in 14 seconds. His stomach made the decision first. Sign 3. You think in ROI, not in dollars. You don't see a $200 software subscription. You see the number of client invoices required to cover it. You naturally denominate costs in required revenue, which creates a friction that prevents impulsive spending. Garrett calculated every single expense the same way. How many cleaning contracts does this cost me? He did it automatically. Never taught it, never named it. Sign 4. Your reward comes from margin, not revenue. Most business owners get a psychological reward from announcing a $100,000 month. You get that same reward from watching your cash reserve grow, even if revenue stays flat. Your brain has correctly identified which metric predicts survival. Revenue keeps you busy. Margin keeps you alive. Sign 5. You agonize over small recurring costs, but move fast on large investments. You spend a week evaluating a $20 per month software subscription, but you'll commit $10,000 to a key hire or a critical piece of equipment in 48 hours. This is not an inconsistency. It's precision. Small recurring costs compound silently and drain cash flow for years. Large investments are pre-calculated assets with defined return timelines. Understanding that difference instinctively is a capital advantage most small business owners never develop. Sign 6. You resist revenue-matching lifestyle upgrades. As your revenue grows, the pull to upgrade your branding, your office, your tech stack, it's real. You feel it, and you override it. That override is your competitive edge keeping you lean. Every dollar not spent on performed success is a dollar available for actual growth. Garrett's office, a folding table in a spare bedroom. His profit margin, 36.6%. Sign 7. You make decisions for the 5-year version of your business. When a decision lands on your desk, the question isn't, will this help us this month? The question is, will the version of this business that exists in 2030 be burdened or helped by this choice? Most business owners vote for this month. You're voting for a decade. Sign 8. You run pre-decision simulations. Before signing a contract, before hiring a vendor, before committing to anything significant, you already ran the worst-case scenario in your head. You felt the regret before you agreed. That simulation is what stopped you. This is not overthinking. This is your version of corporate due diligence. Sign 9. You know your key numbers without opening an app. Right now, without checking, you can tell me your customer acquisition cost, your profit margin, and your exact cash runway. Garrett knew his to 2 decimal places, not because he obsessed over dashboards, because these numbers lived in his ambient awareness, the way a pilot monitors altitude without staring at the dial. That background awareness is what prevents the sudden cash crisis that ends small businesses every day. Sign 10. You don't broadcast your wins. When you land a significant contract or hit a revenue milestone, the quiet growing bank balance is the reward. You don't need the LinkedIn post to confirm it's real. The most profitable business owners build wealth in private. The loudest rooms are rarely the richest ones. Sign 11. You practice defensive pessimism as a core strategy. You've already mentally rehearsed losing your biggest client. You've planned for the market downturn. You've built the contingency fund for the supply chain failure that hasn't happened yet. This is not a negative mindset. It is the most proactive form of risk management available to a small business operator. Garrett had 8.3 months of operating reserves, not because someone told him to, because the alternative kept him awake at night. Sign 12. You get excited by genuinely boring milestones. 6 months of operating expenses in reserve, a finalized employee handbook, a documented onboarding process that runs without you present. These are the survival milestones, the ones that determine whether a business is still operating in year 5. Your brain has correctly identified what matters, and it rewards you for building it. Sign 13. You research small optimizations obsessively. You spent 4 hours fixing a minor onboarding glitch that saves 3 minutes per client intake. You did it because your brain is building operational intelligence that will apply to thousands of future decisions. You're not fixing a glitch. You're building the system that runs your company more profitably for the next decade. The obsession is the strategy. Sign 14. Saying no feels like relief, not loss. Turning down a bad client, passing on a trendy marketing platform, declining an expensive partnership. It doesn't feel like you're missing out. It feels like a release of pressure. Every confident no protects a yes that actually matters. Sign 15. You feel guilty taking money out of your own business, even when you're profitable, even when your reserves are healthy, even when every metric says you can afford it. Pulling an owner's draw still feels like a small betrayal of your company's future. That guilt is not a flaw. It's the exact psychological trade-off that separates operators who build lasting businesses from operators who extract maximum short-term value and wonder why growth stalls. Garrett hit 13 of 15. He thought he was scrambling. Here's the uncomfortable truth about the lean operator profile. Every sign on that list is a competitive advantage. Every single one of them looks, from the outside, like modesty, like insecurity, like someone who doesn't quite believe in their own success. The market will never reward you for these traits publicly. Nobody writes a business book about the owner who said no to the office lease. Nobody podcasts about the operator who drove the paid-off truck. But the acquisition teams do, and the 10-year compound returns do, and the cash reserve statements do. If you recognized yourself in 8 or more of these signs, your business mindset is already more developed than you realize. The question isn't whether you have the profile. The question is whether you'll trust it before the window closes. That window has a name, and it has a timeline. Most small business owners encounter it exactly once, usually the moment they realize they waited too long. Business facts they never taught you. Next video.